Okay, thank you for watching our latest Artemis Live interview. And today I'm delighted to be joined by Cory Anger. She's the Managing Director and Head of ILS Structuring at GC Securities, which is the specialist capital markets unit of reinsurance broker Guy Carpenter. Cory, great to see you.
Great to see you as well. Thanks, Steve, for having us, and glad to see you're staying well, and hope all of our viewers are staying well, healthy as well.
Sure, I think we're all doing a lot of video time at the moment, so let's add you to the list. So, as with everyone I'm talking to at the moment, because the pandemic is still fresh in everyone's mind, and obviously affecting both insurance and reinsurance markets, and as a result, ILS as well. I guess let's start off with when you give me a little bit of discussion about how you viewed the impact on the ILS market from your sort of point of view. I mean, you spend a lot of time with sponsors, but also talking to investors as well, and working on the transactions that were coming to market. So I'm interested in how this affected your day job and the marketplace from your view.
Certainly. So 2020 was already going to be a very active year. We had a large amount of transactions that were scheduled to mature and that needed to be replaced in some fashion, whether it's through ILS capital or traditional capital. So we were already naturally busy and in the issuance swing for ILS product. Really at this time of the year, most of the activity is focused on the 144A cat bond market, to a certain degree, the collateralized reinsurance market as the key renewal dates come up. The sidecar market is actually less active. It's typically a 1/1 time period where most of the transactions are put in place, and then there's a couple select facilities that do 6 or 7/1 renewals. But in general, this time period had been a very light time period for that activity, which is very good because obviously the turmoil, both from just the emotional turmoil, the broader economic impact turmoil. No one quite knows exactly what our way forward is going to be out of this and how the world will change from it. And what does that mean for, our space, but also just means for investment dollars and how people think about it. So it's been a very, very interesting time period. If I was to focus in on kind of March, which is when we saw the reaction to the broader capital markets, which then fed into a reaction of the traditional capital markets, what became very important by mid-March was access to liquidity. In the sense that transactions that were in progress, being marketed, fairly far along, all closed, with terms and conditions, capacity, and limit, like it was happening before the peak part of the reaction of COVID-19 is more real than people were thinking, or it's actually real now because it's affecting me in my own backyard or how I'm operating. And then what we really saw in the second half of March was the reaction of, what does this mean for the global economy? What does this mean for how I want to be invested? And what does this mean for my investments in this space? We saw a significant amount of secondary trading. There was actually 2 primary issuance deals trying to get done at that time. Both of them paused in order to let these, because of the selling activity that was happening in the secondary market, to let that kind of work its way through. And it was very interesting to see the investors that were looking to sell versus those that are looking to buy. One of the things that I'm most proud of is that this marketplace, again, has reaffirmed that it does perform differently than the broader capital markets. If we look at the total return performance between the end of January to, I think, April 3rd is what we looked through for the Swiss Re Total Return Cap On Index. It was down minus 0.8%. And historically, over that same time period, if you looked over the last 5 years, it ranged between 0 to a positive 1.1% return. So what that means is that we had a more muted reaction as represented through the Cap On Index to the valuation of this product. But if you were to look at more traditional asset classes, if you looked at the same time period for the S&P 500, they were down roughly almost 23% during that time period. And it was the same whether you looked for high yield index, in a similar range, you looked at commodities, you looked at hedge funds. And then when you also looked at the correlation of how ILS, as represented through cat bonds, versus those same asset classes from 2005 through the beginning of April 2020, you can see a substantially lower correlation pattern between ILS investments versus the other asset classes, which generally ranged, would be, about 50% to even the high 90s amongst traditional capital markets asset classes. But then when we looked at it for versus, the total return cap on index, it was around a 19 to 23% correlation. Mm-hmm. So really that low correlation is very powerful to the money that can come in and support this space. And I think this is going to be another example after, like we had with the financial crisis, of why investing in this space is helpful from an investor perspective in diversifying their portfolio. But also it's going to reaffirm the valuations of the individual product. Individual securities will have a range of valuations, but when you see traditional capital markets products having a much lower valuation versus the cap on product on average holding its valuations in the mid to high 90s, I think is fairly remarkable. Yeah. And what we did see is in the camp of ILS investors, the dedicated insurance-linked funds having cash on hand to support the purchasing of those that need to sell it, versus really the multi-strategy investor, direct multi-strategy investors that invest into the space were the big catalyst for those that needed to sell or adjust positions. And we saw it was probably an aggregate between 700 to 900 million of product that traded through a variety of formats during roughly in a 3 to 4 week time period. And so it's interesting, you would say, okay, why is the dedicated funds not facing as much selling pressure versus the multi-strategy funds? Obviously, the multi-strategy funds had 3 reasons. One, they could be facing investor redemptions. They could be facing margin calls. For instance, if they put a currency swap on top of the investment. The other thing is that they may want to rotate into other sectors because they don't only invest in this space and may want to take advantage of what they believe are higher yielding opportunities. And so I think those were the reasons that we saw for folks potentially migrating some cash or some investments out of this space into other sectors. But from our dedicated insurance-linked security funds, because this is all they do and are captive and may have capital lockup time periods, they have the ability to buy these products at attractive levels. And we saw that both with investments that don't have a lot of risk left in them, investments that had just been placed. It was very robust in the type of transactions that we're trading in the secondary market. Yeah, no, it's been a really interesting period to sort of watch the market as an observer, but I'm sure if you were a trader at the time, it must have been quite frantic at times anyway, those few weeks. But it was very interesting because the ILS market is it's almost like a very small niche boutique capital market in its own right. And it was clear, even to outsiders like us, that we could see that the market was managing the capital and the availability and making sure that the investors who wanted to get out had the chance to get out. Others who maybe had money to spend, they could take that opportunity and support them. So it was quite positive, I think, from both sides. And I've spoken to investors since who just felt that the market behaved in a very sort of mature manner, which I think is good as well, on top of the non-correlation aspects. So alongside that, we've now seen, I mean, we were seeing this anyway, but we were seeing primary issuance cat bonds. Prices were beginning to rise and have been through the first quarter, which was obviously a record quarter to start the year off. So now we're seeing sort of the coupons seem to be going up quite considerably in recent deals. There's definitely a higher sort of rate hurdle that they're heading towards. It seems very healthy, but I'm interested in your sort of point of view on that. Do you think that's
that's warranted for the state of the market right now, given the way insurance and reinsurance is going as well?
So I think the key word that I would use in this time period is fluid. It's a fluid nature. Or how people are viewing risk and how they want that risk package seems to change by the day. What we were talking about 4 weeks ago is very different from what we're talking about now. And what we were talking about 7 weeks ago is very different than now. So you're absolutely correct that coming into the first quarter of 2020, we were up probably year over year about 10% from a price increase, and we are up from that level from really the mid part of March, when I kind of say it's the starting point of really COVID-19 and people thinking through the implications. The ILS community had a much quicker reaction than the traditional market, and maybe that's for a couple reasons. The traditional market wasn't really being as reactive on pricing, but in the initial stages, it was really mostly an asset impairment as a result of COVID-19. And when you look at our P&C insurers and reinsurers, they generally are in very liquid, high quality, short duration investments, because they don't know if and when the severity event may affect them. So they don't take a lot of asset risk per se. That I think some of the analysis that I've seen internally, and it may have been published by Guy Carpenter, was maybe roughly a 10% hit on the valuation of investments. So initially, the view of the impact of COVID-19 was going to be more muted. It's really the discussion of whether COVID-19 is covered in insurance and then following through reinsurance and retrocession policies. What the scope of coverage is, whether it's covered, and how it's interpreted. And I think as you've seen more analysis being done by insurers and reinsurers, that is where you started to see a shift in how they're thinking about taking on risk going forward, which is translating into further price increases, and in some cases, not supporting programs in the way that they have in the past, or willing to support other programs in a different way. And so as the traditional market has adjusted, it's really in the sense kind of caught up, I would say, with where the capital markets was viewing where pricing and terms should be. But it's just that the ILS market did it much more quickly. Right. They ramped up much more quickly on that. And so I definitely see that rates are up probably 10, maybe in certain areas. Florida's the most concentrated area, and it requests the most limit globally. That's the area that takes the most price increase when we face these types of conditions. And so, we may be up 10 and a further 10 to 15% on top of where we already were. But the one thing that we're very much mindful of, and that we remind the ILS community, in addition to our cedents, is that the market is now, they're so complementary. These products work so interchanged with each other that cedents are at a point where they're going to look for the best coverage terms and best pricing. Mm-hmm. And so if the ILS market gets to a point where they continually move the bar in an adverse way to the cedents, you will see a point where there's just no opportunity coming from it. Not everybody that has a maturing deal is coming back to the market. Some were already not planning to come for other reasons, but pricing can be a reason that they will say, I don't necessarily need to take this capacity in this form this year. And so cedents are much more mindful about the alternatives that they have. And I saw this back in 2005, after Katrina, Rita, Wilma, where ILS pricing went up much more rapidly and quickly than the traditional market. And it got to a point where there was capacity there, but nobody was taking it because the terms and conditions and pricing were so off market. Mm. And then what happens is that you get to July, you're through the key renewals, you have excess capacity. And that's probably the hardest thing for a manager of ILS capital, to be sitting on cash. Mm. You can't do that. And so they need to be mindful, as we're dealing with the 6/1 and the 7/1 renewals at this point, that if you hold out for too long, you may end up in a point where there isn't that opportunity. And our insurance clients don't react like traders. They will not just say, oh, opportunistically pricing is adjust and I will now come back and buy it. They will get the program placed by their key renewal date, and they won't really entertain looking at it for another 6 to 9 months as they start to think about the following renewal. So that's the key tension that the ILS community has to keep a pulse on in order that they maintain their attractive nature and participating on programs.
Yeah, and of course, with most of the ILS capital is also writing traditional reinsurance in collateralized form as well. They're putting the two products that they write against each other in some cases, I imagine, as well. Do you think this is a hurdle that can be sustained for a period? Is it your feeling that this is higher rates are going to be sustained for a while this time around, or are we just waiting for the next round of inflows and then we'll see it change again?
So I do think what's going to be interesting is we will see capital coming in, and I think that kind of the investment consultants, because of how they view the performance of the space, in March as an example and prior examples, are advocating that it still makes sense to invest in this space. And I think we've already seen some legacy investors that maybe they didn't participate as much as they used to because of pricing declines over the years, have stepped back into the market and have stepped in very quickly. So we think that there will be capital that comes in that wants to take advantage of the opportunities. I think that the pivot's going to be from here. A lot of the 6/1 and the 7/1 renewals are in progress, is thinking about for the 1/1 renewals. And we have one wild card that can change the whole process, and it's not COVID-19, which is admittedly still ongoing and evolving and developing, but it's the fact that we're heading into a hurricane season that the experts are saying that the conditions are there for more increased activity. Whether that translates to activity that causes the property damage, that causes the losses for insurers is a second question. But the last several years have been years where they would say they're either average to below average. And now they're saying we think we have the climate attributes that are going to cause increased activity. And if we have significant losses, it's only going to exacerbate the situation. So I really think that being proactive and already thinking about January 1st and how you're going to manage your capital and surplus positions and whether you need to use ILS for it. It's going to be interesting to see how COVID-19 could affect collateralized reinsurance and sidecars. And so there could be a pivot of more use of the 144A cap on capital because it's generally been insulated to COVID-19. But the fact of the matter is that while there is new capital coming in, there is a finite amount of capital. And I think that as we get closer to the January 1 renewals is when people are going to get more concerned about what capital they're going to have the ability to write with in 2021. So we're already starting to see a little bit of pivot, but everybody really needs to get through the 6/1 renewals to then start that conversation.
Sure. Yeah.
And I think it'll start earlier this year.
Right. Okay. No, it's interesting. I think the retrocession market is somewhere that will be incredibly interesting towards the end of this year, based on, as you say, whether collateralized reinsurance ends up taking some of the COVID losses, and how trapped capital could affect retrocession availability, and traditional retrocessionaires may not be as capital flush as usual as well, and that could be a really interesting area towards the end of the year and into 1/1, but also potentially provide opportunity for the cat bond market. Index bonds have been very popular, haven't they, in the sort of first quarter of this year. Potentially we could see a lot more of them later in the year.
Absolutely. I also think that an area of growth, and this is a longer term type of growth prospect, is the fact that many people hadn't been as willing to buy pandemic coverage. Either they didn't view the risk as material, or they weren't willing to pay for a cost for it. And I think that whole world is going, whether it's you're talking about hospitality and transportation, and rethinking it, whether your healthcare and kind of the provider of the morbidity type of coverage, and needing to manage costs there. But I think there's a whole opportunity there of growth for, kind of pandemic type of covers. And I think ILS can be a key component of it. I understand that someone could take a view, well, look at the performance of if I had invested in something that responded to COVID-19 and look at how my investments were performing at the same time, they would say, well, there's correlation there. But if you look at the type of events, even that are pandemic related, that there isn't that necessary correlation, there's still a lot of opportunity where you can still invest in that risk and have the low correlation that you're looking for. The fact that most economic events that affect the valuation of broader capital markets investments usually are unrelated to pandemics. It's economic, it's geopolitical, it's war, it's a whole host of other things that would never affect the valuation of a pandemic investment. And even within the pandemic realm, there's a variety of those type of events that don't cause kind of a roiling of a global capital markets. You can look at SARS, you can look at H1N1, you can look at the Ebola event in Africa. And so I think that there's going to be a lot of opportunities there, and we look forward that ILS Capital will be open to entertaining structures that can help to meet the needs that we expect to come down the road.
Yeah, no, that's interesting. Moving to the sort of the sponsor side, what advice would you give to reinsurers or even corporate sponsors looking at the market at this time? Would you say now's a good time to begin your journey in trying to tap the ILS market, or is it a challenging time potentially for people because of investor demands elevating a little bit?
Usually it's these type of events that are catalyst for folks that haven't done it to start looking at it, because they know that they need, that if there's going to be stress in covering their capital and surplus needs, that they need to go through this process. But then we have a whole host of cedents, not just new cedents, but existing cedents that are well familiar with the product and are use this capital with the other sorts of complementary capital, and it's kind of fungible back and forth in how much that they want to use. So in my opinion, we have not really seen them say, I'm not going to proceed, or this is not the time for me to evaluate it. In fact, it probably causes a little bit more conversations when the markets get stressed. And that's at all levels, whether you're talking about corporates, insurers, or reinsurers. They're all evaluating this sort of risk transfer protection in whatever format that they want to do it. Again, it could be sidecar, it could be collateralized reinsurance, it could be cap bonds. We're having those conversations. But we are, saying, listen, we don't, I think the one nice thing about being on the Marsh & McLennan platform is the fact that we're not beholden to one particular type of risk transfer capacity. So from our perspective, if you're seeing a better opportunity in a different product, and as the market's shifting, grab it, take it, run with it. But we're here, but this is where the terms of the capital are, if that fits what you're looking to do. So from my perspective, I've not seen any slowdown from both existing and certainly have had and will continue to have opportunities to talk with new sponsors.
Good.
I do think that there's particular renewed focus among the reinsurer community, and relooking at a variety of products, again, as they're starting to think towards January 1.
Sure. Yeah, no, I think that there could be opportunities in many different areas of the market at the moment in terms of portfolios that are slightly distressed that people might need capital support for, plus just reinsurers whose capital's been significantly dented in on the asset side. They may find reinsurance capital as an additional boost at this time. Are there any other new themes that you're looking towards, sort of towards the end of the year? I know it's been a very busy period and sometimes you don't get the chance to really look ahead, but it'd be interesting to hear your thoughts on what might come down the line further ahead.
Well, I have to be careful because it is a competitive realm.
No trade secrets.
No. And I think, GC Securities has been at the forefront of thinking through new situations and how to bring new risks, how to structure existing risks in a more desirable fashion that gives you enhanced coverage or better pricing. And so, we're constantly looking at it. I don't necessarily see, new themes. Listen, I think that I get a lot of questions on parametric covers and the use of them, and I think that's going to continue to evolve. I'm excited to see what people are creating. I think the pandemic is definitely an area that there's going to be enhanced coverage. And really within the kind of property cat realm, it's just the standard blocking and tackling and finding new ways. So, I can't point to one particular peril, one particular or insurance line, or one particular geography at this point.
And so just for the rest of 2020, do you have a view on sort of where we might end up in terms of issuance this year? It's you'd think it's probably unlikely to beat any records, but it still feels like it should be quite robust from the last few weeks. Investors have come back and supported the recent bonds really well. Do you have an inkling on how we might do over the next sort of 8 months?
Yeah, so if we look at what has matured and what we have issued, I think through the end of what has closed at this point, we're up almost 500 million in growing the amount of assets under management in the 144A cat bond market. I think probably the sidecar market and the collateralized market is probably going to be static in the growth pattern. I think where the disproportionate growth may come from is the 144A cat bond market. We do have a lot of maturities coming up still. We've got 1.8 billion in June and another billion in July. After that, it's about I want to say 2.4 billion for the remainder of the year. So we still have a number of sizable transactions that come through. But what's key to note is that we're going to have another high redemption year next year as well. Mm-hmm. I think it's roughly 8.9 billion next year that is going to free up capital. And so this catalyst for capital availability in absence of new capital, which I do believe will continue to come in, is going to continue to go. And I think that's go on, easily for the next year. And I think that's going to help the market as we're working through the difficult implications at this point. But I do think that there will be a potential for increased response, in particular from the reinsurer community as they're thinking through January 1 renewals, of activity that could happen really, I think, between July and end of the year. And then, many of the programs, people that have maturities, it's going to be 2017, 2018 vintages that will come off next year. And certainly they're going to need to look at all the alternatives, given the pricing implications between how 2017 and 2018 were versus at least where 2020 is right now.
So no, which all points to the fact we could actually have a few busy years ahead of us with all the capital being freed up, and if there's new inflows as well. So it sounds quite positive overall. Thank you very much for your time, Cory. I really appreciate it. I won't keep you any longer. It's been great to talk to you, and look forward to being able to see you in person soon.
Absolutely. It's a pleasure to always speak with you, and I hope all of your users found this informative
Thanks,
today.
Cory. I'm sure they will. Bye.
Okay, thanks.